All right, guys, here we are. AutoTrader Group, potential investment into stock portfolio. I'll take you through the company review using my system and let's see if it's worth investing in. But just be very clear at the start, general information, not personalised advice to you. So with that disclaimer out of the way, let's get straight into it. We are going to start with the return on capital employed. This is a measure of how well the business can effectively reinvest into itself to grow, how good the management is, and it's a decent proxy for the long-term return of the business. So we go into the TIKR terminal, we're going to have a look here at return on capital, and that return on capital over the last 10 years is consistently extremely high. 20% is probably the minimum I'd want. A really strong figure is 30% or above. This is every single year above 30%, with the most recent figure on the right, 54%. So return on capital, which is one of the key measures for me when I'm looking at an investment, is very strong. So we're going to drop a nice tick in that return on capital box, but we need to check those margins. So if we go along here and we look at, first of all, gross margin, what's the pricing power like? That gross margin is exceptionally high. And then we also want to look at the operating margin on the income statement, and that operating margin every year is over 50%. So this is incredible. This is a really, really high quality company on those metrics. And also I'll have a look at quality in terms of cash conversion as well. How well they translate their actual profit into free cash flow. Now in the last 10 years, that is well over 100% average, and in the last 5 years, the average is over 100% as well. So they are translating their profit into free cash flow, which is what we're interested in. And there we go. Adobe's telling me to update. Let's get rid of that. So if we go back to our checklist, margins, nice big tick. Now, rule 1, Warren Buffett, famous rule 1, do not lose money. And then rule 2, see rule 1. That can take many guises because you can lose money by overpaying. But in this case, what I'm talking about is losing money by investing in a business that fails or has a chance of failing. And there are probably 4 things I'm looking at, maybe 5. We go back to the TIKR terminal, which is a great resource. I'll leave a link for you below on that referral link. So it'd be great if you consider checking that out. We're going to have a look at the ratios again. And we're going to take a look, first of all, at the current ratio. That needs to be above 1 for all periods, which it is, and comfortably so. So their short-term obligations are likely to be met. We look at debt to equity. That was pretty negative before, but that's now very, very low, hovering around that 10% mark. Certainly you want below 100% there in most cases. And interest cover. Now, interest cover is the ability to cover their interest payments. That was pretty bad 10 years ago, just 1.5, really bad. I'm looking for stuff that is, let's say, 14, 16 or higher. We're in the sort of 80 range. So again, really, really good. And then finally, of course, if we look at the age of the company and their industry, this company actually is quite old. I didn't realise AutoTrader Group, 1977. So back to our checklist, I think it's pretty safe to say, although never certain, rule 1 is a tick in the box there. Now, other facts I'm looking at in terms of the concentration of their customer base, is it kind of one-off purchases, or is this something that could be looked at in the future? Is the industry suitable? So all those things I think are fine. They don't have a high capex, so their operating cash flow translates well to free cash flow. They're not having to build loads of equipment, machinery, buildings in order to keep making money, so that's a good sign. So those factors are good. Then I'm looking at the dividend. Now, if we have a look at the dividend, and the best way to do that is probably, again, TIKR terminal. You can also use simply Wall Street for that. We can see here their dividends per share, they're pretty low, 2p, 5p, 6, 7, dropped, and then worked to 9p. Pretty low dividends. The yield today is 1.2%, but this isn't a dividend company. You don't want them paying out dividend if they can reinvest into themselves with a high return on capital. But that payout ratio clearly shows that dividend is affordable around that 30% mark. So that's a good factor in their favour. Nothing to say on insider ownership. If we have a look at that on Simply Wall Street, no transactions, there's not really any insider ownership there. And also I like to have a look at the kind of shares outstanding. I tend to pick the number that's higher here. And you can see it's dropped most years, a couple of percent. The return could look like how their earnings grows in the future, plus 1 or 2% on buybacks, plus 1% or so on dividends. I'm going back here. I think the other factor is a tick. Now the future growth, this is really, really an interesting one. So future growth, we've got expected earnings growth at around about 12% on Simply Wall Street. And in the past, they're saying about 6%. Also look at the Yahoo analyst piece as well. And we've got 6% again in the past and 8.5% in the future. Now I'm going to go towards the conservative side. I'm going to go for 9%. And ideally, I'm looking for sort of 7% a year plus. So 9% is fine. So that gets a tick. And then don't overpay. So if I'm thinking at Terry Smith and Fundsmith, and here is his recent letter that's come out in the last couple of weeks, we can see here he's got return on capital in his portfolio averaging 30%, whereas the FTSE 100, which Autotrader's in, is averaging 17%. We can see that they're clearly much higher quality company in the FTSE 100. Their return on capital is about 3 times higher. And we talk about don't overpay. It's not just a raw number based on, let's say, PE or free cash flow yield. You have to consider the quality of the company compared to the index as well. So their gross margins are double, if not more. Their operating margins are 3 times, if not more, higher. Cash conversion is higher. Interest covers 8 times higher. So Autotrader, you would think, should kind of be quite expensive compared to the FTSE 100. Now, the free cash flow yield, which is the free cash flow divided by the market cap, is 4.16%. And there's 3 things I like to do in order to try and work out an approximate kind of valuation. And what I mean by that is, what's the rate of return? Because I, for my portfolio, want 10% a year plus. And there are 3 ways to do that. One is to take the future growth rate, and then you can add on to that either the inverse of the PE or the free cash flow yield. And in this case, that makes around about 13% per year. The second way to calculate potential return is to do discounted cash flow, which I think is very appropriate for this company, established company that kind of converts its income into free cash flow. Now, I've pulled those numbers through. I use 2 methods. I use this calculator, which does a kind of, if you hold the company forever, how much will it generate on the Buffett's Books website. I've also got my own one where I do it based on a terminal multiple of selling the company after 5 or 10 years, and kind of get those 3 calculations, these 2 here, plus the yield and growth rate one, get those 3 together, and that gives me a bit of a range. So for holding this company for 10 years, my estimate, and of course not guaranteed, but my estimate is a minimum of 9.1% a year return. So slightly below my threshold. I think the maximum would be 13.2%, and the average of those 3 measures is sort of 10.8%. So broadly speaking, I reckon if you hold this for 10 years, assuming 9% a year growth holds for all of those years, which is the question mark, 10.8% a year is the sort of return I would expect to receive in my portfolio on this. Very respectable. So I think it's fair to say one probably isn't overpaying for this, at least by my criteria. The quality of the company is so good. I'm not looking for cheap because the mathematics are compounding. I'm just making sure I don't overpay. Back to the checklist. 6 green ticks. We have 6 green ticks, which is pretty hard to get. So by current review of Autotrader, for me is a buy. It's definitely a higher quality company than some positions in my portfolio. And because I don't want to increase the size of my portfolio, because I haven't got it down to that 20 to 25 individual stocks yet, I need to sell before I can buy an initial position in Autotrader at the current market price of around about £7.13. And it still seems like an okay price, not overpaying. The metrics are clearly high quality. I need to do a little bit more research, but certainly it looks like a buy for me.